Okay, good evening, everybody. Welcome to all of you at the ACCA Prepare to Pass Practice to Pass session of Financial Reporting, paper F7. My name is Hamad Sarwar. I'm your facilitator for this session, and I teach paper F7, F8, and SBR paper at one of the leading institutions of Karachi, Pakistan, that is Tabani School of Accountancy. I have been teaching this paper for the previous 8 to 10 years, so I've got a large amount of experience of this paper and about the exam techniques and examiner approach. And I can assure you that if you people have carefully attended this session and do all the practice questions which I recommended to you, then inshallah you will surely pass this exam with good marks. There are a number of questions, the number of students who usually ask about paper F7, they got flunk in 40s and 50s, 40s and 30s. So they are very much worried about how to pass this paper. So my answer is focus on the IFRSs, focus on the practice, and you have to focus on time management. And from with the current scenario, you should have a sound grip on the platform of ACCA. Working on the computers is very important for all the students while doing practice. Mostly students do practice through pen and on the paper. It's very important for the students to do the practice on the computers at least in the month of February. So let's start from the first slide. Today is 13th of February. We are going to start our day one. Okay, the norms of this session is you have on the right hand side you can see there is a handout section in which you, through which you can download the day one handout and practice handout. And secondly, you have a chat box on the right hand side where you can ask any type of question you wanted to. So as you all know that it's a practice to pass session, so we have to do a lot of practice in this 2 to 3 hours, and I would recommend all of you to please focus on the lectures and the key concepts. I will quickly go through all the concepts and focus on the practice, but if you really wanted to ask uh, the concepts in more detail, you can contact me on my WhatsApp number. I'll share my WhatsApp number later on, and you can ask any type of questions. And on a daily basis, I will give you some questions for the practice, and you have to email me, and I will check your answer script and reply you with the feedback. So this is a 10-hour session of paper FR. So let's start from the first slide. So the format of the paper comprises of three sections, that is section A, B, and C. Section A includes 15 objective type questions like MCQs, which in total will give you the marks of 30. And section B covers 3 OTQs of 2 marks each, and the worth of this section is also 30 marks. Section C will be the constructive response questions, in which examiner is going to ask 2 questions, uh, 2 long questions. For each you will get marks of 20, and all questions are compulsory for this paper, so there is no choice. You can see the past trend, exam pass rates and pass trend of this paper is 51 to 39. The average passing ratio of this paper is approximately 49 to 50%. So all of you should consider this, that almost 40% of the students got failed in this examination because of lack of practice, because of lack of key concepts of IFRSs, and especially lacking in the computer skills. The seeded question, yes, there is one seeded question in section B, uh, which does not have any marks, does not carry any marks. You attempt that seeded question right or wrong, it does not affect your performance overall. But examiner never mention which one is the seeded question. So you don't have to worry about the seeded question. Seeded question is actually for the future examinations. So here we have the planner for the 4 days. In day one, we will be covering the key IFRSs that is relevant for this March attempt. Then we'll be covering IFRS and final account in day two as well. So in these 2 days, we'll be focusing on a 20 marks question of the final account and the key IFRSs that is relevant for March attempt that will be helpful in section A and B. In day three, we'll be focusing on the consolidated balance sheet and consolidated income statement and some MCQs and OTQs relating to consolidation. And in day four, mostly the students struggled in this topic, that is ratios, because of the lack of writing skills. So in day four, we'll be focusing on the ratios. So you can download the practice handouts of day one and day two. You can see here that I have selected 5 questions of final account for the practice, and I think this 4 or 5 questions is more than enough for the practice till the examination date. So I have selected these 5 questions, and these questions we'll be covering these questions and some MCQs and OTQs in day one and day two. So I have selected 5 important questions. So doing the practice of these 5 questions is, I think, more than enough for the examination, because we already have almost 14 to 15 days remaining in the examination. So these are the 5 questions I've selected. Now, these are the key IFRSs that is relevant for this session, that is IAS 16, 40, IAS 12, financial instruments, IAS 8, IAS 36, IFRS 5, and final accounts. This is the scope of day one. And day two, we will be covering the area of substance over form and IFRS 15, IFRS 16, IAS 37, IAS 38, and final account. So these are actually the most important standards for this attempt, for March 2019 attempt. Okay. So for the final account questions, examiner will normally giving, wait, I'm just selected my pen. Okay. For final account question, examiner will give you normally 5 to 6 adjustments in the final account. So first adjustment will definitely, or one adjustment will definitely be from IAS 16. One adjustment will definitely come from IAS 12. One adjustment will be the must area from the financial instruments. So 1, 2, 3. Then fourth adjustment will be from the substance over form or IAS 2, that is inventories. In fifth and sixth adjustment, examiner can give you any standard. It might be from IFRS 15, it might be from IFRS 16, it could be from IAS 37, 38, IAS 8, IFRS 5. It could be a simple adjustment of right shares. It could be a simple adjustment of bonus shares, or it could be a simple adjustment of simple share issue that is relating to suspense account. So we can say that for the final account question, IAS 16, financial instruments, and substance over form, and IAS 12. These are the 4 important areas which is compulsory for all the examinations. But the other standards, I think these are the related other standards that is relevant for March 2018. One of the students wanted to have asked that what about the EPS? Okay, EPS can be examined in section A, that is MCQs area, and there is a very least likely chances that an examiner can ask EPS question in this attempt, but you can expect a single one or two question from the EPS, not more than that. But because all that you all have known that it is a session of 10 hours, so I have to select and cover the most important aspects of paper F7, rather than I cannot cover the whole syllabus, but I can guide you on the WhatsApp, and you can uh, just take the tips through me on WhatsApp, and you can ask me through email. So let's start from the first slide. Now the one adjustment must be always be from IS 16. So the most important area of the examiner in IS 16 is the area related to the revaluation. Revaluation means the difference between the net book value and the fair value or the market value of the asset. So whenever we compare the net book value with the market value or the fair value of the asset, this process is called revaluation. So we are actually upgrading our net book value according to the market value. So sometimes there could be a revaluation gain, or sometimes it might be a loss. So one adjustment must be from the revaluation, or it could be from a simple depreciation topic. So from straight line method, you all should know the formula of straight line, that is cost minus scrap value divided by remaining useful life. And for reducing balance method, we have to calculate the depreciation on cost less accumulated depreciation into percentage. So actually we charge the percentage on the net book value of the asset. Okay. IS 16 has got two models after the initial recognition, that is the cost model and the revaluation model. On the cost model, we have to measure the asset at the cost less accumulated depreciation and impairment losses. And under revaluation model, we have to measure the asset at the fair value less subsequent depreciation and subsequent impairment losses. According to IS 16, the revaluation must be regular. It must be applied from the same class of assets. The upward revaluation will be recognized in equity, and the downward revaluation should be first charged against the income statement. So whenever there is a upward revaluation, it should have to be recognized in equity. But in the previous year, if the company has recognized a downward revaluation which they have charged in the income statement, then the upward will also be recognized and charged in the income statement. But from the first year, if there is a revaluation gain, then it should be recognized in equity. So the accounting entry should be debit asset and credit revaluation reserve. But if the company has previously recognized a loss in the income statement, then for the upward revaluation, the accounting entry will be asset debit and credit income statement to the extent of the loss previously charged in the income statement. For the downward revaluation, the accounting entry should be income statement debit and asset credit. But if there's a previous gain in the revaluation reserve, then the accounting entry should be RR revaluation reserve debit and asset credit. Now, examiner can give you the adjustment of the revaluation, which might be the revaluation was carried out at the start of the year. The revaluation could be at the mid of the year, or revaluation could be at the end of the year. So examiner can ask you three type of scenarios. The revaluation was done at the start of the year, revaluation was done at the mid of the year, and revaluation was done at the end of the year. So if the question says you the revaluation was done at the start or mid of the year, then first of all you have to calculate the net book value at the date of revaluation. Then this should have to be compared with the market value. So the difference could be a revaluation gain or a loss. Suppose I take the value of 100 as a net book value and take the value of 150 as the fair value. So there is a revaluation gain of 50, which should be recognized in equity. And whenever there is a gain or loss that we have recognized in equity, IS1 says that it should also be reported in OCI, that is other comprehensive income. Then after the revaluation, we have to calculate the revised depreciation, which should be valued measured at the fair value divided by remaining useful life. Whatever with the remaining useful life should be used for the calculation of the revised depreciation. And there might be some excess depreciation adjustment if the question says that the company has got the policy of transferring the revaluation reserve to the retained earnings. So if the company has got the policy of revaluing, if the company has got the policy of transferring the excess depreciation, then you should adjust the excess depreciation. Otherwise, there is no need to adjust the excess depreciation. So the accounting entry should be revaluation reserve debit and retained earnings credit for the excess depreciation. So you can calculate the excess depreciation by comparing the new and the old depreciation, or you can calculate the excess depreciation by dividing the revaluation reserve balance with the remaining useful life. Similarly, whenever there is a revaluation gain, then you have to book a deferred tax liability if the question says you that you have to calculate the depreciation deferred tax. So revaluation gain creates deferred tax liability. So the accounting entry should be revaluation reserve debit or deferred tax liability credit. So if you have any questions, you can ask on the chat box. Okay. There's a student who wanted to ask, can you tell us about some probable questions of this session? Can you email you? Okay. The rate of speech is a bit high. Okay. When is upward revaluation recognized in the income statement? Now the question is, when upward revaluation recognized in the income statement? Whenever there is a previous loss recognized in the income statement, then company should have to recognize the upward revaluation in the income statement to the extent of the loss previously charged in the income statement. Okay. Second is, please repeat the deferred tax gain. Whenever there is a gain in the revaluation, then you have to pay taxation on this capital gain. So accounting says that you have to book the deferred tax liability by multiplying the revaluation gain into tax rate. But the impact of this deferred tax liability should be reported in the revaluation reserve. So the accounting entry should be revaluation reserve debit and deferred tax liability credit. Okay. I don't see the checkbox. You can see the chat box on the right hand side. You can see chat box. Okay. Any other question? Speed is okay. Could you please repeat the excess depreciation? Okay. Excess depreciation should only be dealt with in the financial statements whenever the company says, or the question says the company has got the policy of transferring the excess depreciation. Then you should have to adjust the excess depreciation. Otherwise, there is no need to adjust the excess depreciation. So I'm starting from the question that is triage. You can see the question in the Word document. On the right hand side, you can download this document, and there is a question with the name triage. And this part is relating to this note number 2 is relating to IS 16. It says that the company has got the lease property with an original life of 25 years, and the cost of this is 75,000. Plant and equipment cost 72,100. Accumulated depreciation of the lease property is 15,000, and the plant and equipment is 28,100. Okay. The director decided to revalue the lease property at 66.3 million on 1st October 2005. So as you see, you can see that the year end of the company is 31st March 2006. So when we calculate the months, October, November, December, January, February, March, so it will be 6 months actually. So actually the company has done the revaluation at the mid of the year, and it is now 66.3 million. So as I have told you that first of all you have to calculate the net book value at this date. So for the lease property, we have got the cost of 75,000 minus accumulated depreciation of 50,000. There is a net book value of 60,000 at the start of the year. So first of all, you have to charge the depreciation of the first 6 months. So depreciation should be 75,000 divided by useful life of 25 years. So what will be the amount of depreciation? It will be 3,000. Yes. And for the first 6 months, it will be 1,500. So the net book value at the time of revaluation will be 60,000 minus 1,500. It will be 58,500. So the asset has been revalued from 58.5 to 66.3. So there will be a revaluation gain of how much amount? It's 7,800, 7.8. So the accounting entry should be asset debit and revaluation surplus credit by 7,800. So the director decided to revalue the leased property out at 66.3 million on 1st October, means at the mid of the year. Triage company does not make an annual transfer. So there is no need in this question to do the adjustment of excess depreciation, because the company says the question says that Triage company does not make an annual transfer from the revaluation surplus to the retained earnings. Okay. However, the revaluation will give rise to the deferred tax liability for the company at the rate of 20%. So you have to book the deferred tax liability, which should be calculated at 7,800 into 20%. So the amount will be 7,800 into 20%. 1,560. Very good. I want all of you to please participate in this type of calculation. So what should be the accounting entry for this deferred tax? The accounting entry should be revaluation reserve debit 1560 and deferred tax liability credit by 1560. So this is the accounting entry for deferred tax liability. So at what amount we should have to report? Okay. At what amount we should have to report the lease property in the balance sheet? So when we are preparing the balance sheet, the value of the asset is now 66.3 million. And by calculating the depreciation of the remaining 6 months, you have to calculate the revised depreciation. So 66.3 divided by remaining useful life. Can you tell me what should be the remaining useful life of this asset? You can see here that there is a accumulated depreciation of 15,000, and we have calculated the depreciation of the first year. 1 year is 3,000, and 15,000 of accumulated depreciation means that we have already depreciated this asset for the first 5 years. Okay, and we have charged the depreciation for the first 6 months, that is 1,500. So the remaining life of the asset is 19.5 years. 66.3 divided by 19.5. What will be the answer? Divided by 19.5. The answer should be 3400. 3.4. Very good. But we have to book the depreciation for the last 6 months. Therefore, we have to divide this by 2. We got the value of 1.7 million. So in the income statement, there will be a depreciation of 1500 for the first 6 months and 1.7 for the second 6 months. Okay. And in the OCI, other comprehensive income, there will be a revaluation gain of 7800 minus deferred tax of 1560. And in the balance sheet, assets should be reported at 1666.3 minus 1.7 for the accumulated depreciation. And there will be a revaluation reserve of 7800 in the revaluation reserve account minus 1560. And this 1560 should be reported in the balance sheet on the liability side, that is 1560 deferred tax liability. Okay, so this is the presentation of income statement and balance sheet. Please note this presentation because we have to do the final account question. We have to solve 5 long final account questions, and we have done the first adjustment of Triage company. That is the second question actually in my handout. So you can download the Word document of the handout and see there is a second question. The name of the question is Triage. So you have to remember all these adjustments when we are doing Triage completely. Okay, if the revaluation was done at the end of the year, first you have to calculate the net book value of at the end by charging the depreciation of the complete year, and then you have to compare this net book value with the fair value. Then there will be a revaluation gain or loss, and there is no need to calculate the revised depreciation. All you need to do is to book the deferred tax if there is a revaluation gain. So the difference between revaluation at the end and revaluation at the start is when you are focusing on revaluation at the end, first you have to calculate the net book value by charging the depreciation of the complete year. Okay. Then this net book value should be compared with the fair value, and the difference will be recognized as revaluation gain or loss. But if the revaluation was done at the start of the year, then there is no need to calculate the depreciation of the current year. First, asset should be calculated with the net book value at the start of the year, and then you have to calculate you have to compare this with the fair value. There will be a revaluation gain and loss, and for the current year you have to charge the revised depreciation based on the fair value. So this is the basic difference between the revaluation at the end and revaluation at the start. So now we are going to attempt a question in which the company is going to revalue the asset at the end of the year. So this question is related to Kevrin company. The company has got the land of 7,000 and company has got the building with the value of 36,000. Kevrin revalued its land and building at the end of each accounting year. At 30th September 2010 means at the year end. The relevant values to be incorporated into the financial statement is 41.8. The building remaining life at the beginning of the current year, 1st October 2009, was 18. Kevin does not make a transfer. So you can see here there is no policy for the company to transfer the excess depreciation, but you have to, okay, You also have to ignore the deferred tax impact. So whenever the question says you that there is no need to do the adjustment of deferred tax, just ignore the impact of deferred tax. Okay. Now, in this question, you can see that the company is going to revalue its assets at the end of each accounting year. It means first you have to charge the depreciation of the current year using a useful life of 18 years. So by dividing 36,000 by 18, we got the value of 2,000. So the net book value of the building portion is now 34,000. And we all know that the land component is not being depreciated. So by adding the land and building, we got the value of 34 plus 7, we got the value of 41,000. So the net book values of land and building on a collective basis is 41, and the company is going to revalue this asset at a market value or the fair value of 41,800. So actually there is a revaluation gain of 800. Okay. At what amount should be reported in the income statement? In the income statement, there will be a depreciation of 2000. In the OCI, we have to book revaluation gain of 800. There is no need to adjust the deferred tax liability because the question already says you ignore deferred taxation. Assets should be reported at 41.8 million, and in the equity section there will be a revaluation reserve or revaluation surplus of 800.8. Or if we 1800, or it will be 8K. So this is actually the adjustment relating to revaluation. So there is a must question of revaluation in all the final account questions. So you should have a sound grip on this area. So I'm moving towards the next slide. IS 16 says initially the property, plant and equipment should initially be measured at cost. The cost include the cost necessary to bringing the asset to the working condition. So it should include the cost of purchase, and the cost incurred to bringing the asset into the working condition means it might be the cost of installation, it might be the uh, cost of the site preparation, it might be any type of cost which should have to be incurred in order the asset should be in the working condition. And the final one is the estimated cost of dismantling and removing the asset. So we have to book this cost according to the provisions of IS 37. So the accounting entry for the first cost will be asset debit and cash credit. Like if we are doing the site preparation, the accounting entry will be asset debit, cash credit. If you are paying the delivery and handling cost, installation and related professional fee, it should be reported with this amount and with this double entry. But for site preparation or dismantling, the accounting entry should be asset debit and provision credit. And this provision should be measured at the present value of future cash flows. So all of you should know how to calculate the present value, that is future value into 1 plus I raised to the power minus n. So this is how we calculate the present value of the future cash flows. So by adding these all uh, items, we got the value of initial cost under IS 16. Are the professional fee capitalized? Yes, the answer is yes. All the professional fees relating to installation and site preparation should be capitalized. Okay, here we have got the question relating to this part. The property, plant and equipment company acquired on 1st April 2014 an item of the plant had a cash value of 14 million. So company has initially paid 14 million to purchase the plant. However, the plant will cause the environmental damage, which will have to be rectified when it is dismantled. So there should be a site restoration cost. And examiner has already calculated the present value discounted at the 8% on 1st April of the rectification cost is 4 million. So the present value of the future cash flows for the rectification cost is 4 million. So the asset should be reported initially at a value of 18 million. The environmental provision has been correctly accounted for. However, no finance cost has been charged on the provision. So IS 16 says that this cost should be depreciated over its useful life, but the provision area which we have recorded on the present value, there will be an unwinding of discount. There will be an unwinding cost which should be charged in the finance cost in the income statement. So how we calculate the unwinding of discount? We have to use the rate of 8% to unwinding the value of 4 million. So by multiplying 4 million into 8%, we got the value of unwinding, that is 0.32, which should be reported in the finance cost. So the 18 million should be depreciated over its useful life, and the provision will be recognized at the present value, and subsequently there will be an unwinding of discount which should be reported in the finance cost. So the answer for this part is 0.32. Depreciation should be charged on the cost of sale on a straight line basis over 5 years. So the depreciation of this asset is 18 divided by 5. So we got the value of the depreciation of this asset. Okay, so I'm moving forward. IS 16 says that if the asset has got significant components, if the asset has got significant components having different useful life, then each significant component should be depreciated separately. Like we can see in this MCQs, Tibet acquired a new office building on 1st October 2014. Its initial carrying amount consists of land, building structure, and air conditioning system. So you can see that this new office is comprises of 3 major assets. The estimated life of the building structure and the air conditioning system is 25 years. So this portion should be depreciated over 25 years, and this portion should be on 10 years. When the air conditioning system is due for the replacement, it is estimated that the old system will be dismantled and sold for 500,000. So this is actually the scrap value of the air conditioning system. Depreciation is time apportioned where appropriate. At what amount will the office building be shown in the Tibet's company's financial statements? So from 1st October to 31st March, we got the value, we got the time period of 6 months. So for the building structure, the depreciation should be 10,000 divided by 25 into 6 upon 12. And for the air conditioning system, the depreciation should be 4,000 minus 500 scrap value divided by life of 10 years into 6 upon 12. So assets should be measured reported at cost minus accumulated depreciation. So the cost of this office is 16,000. all you need to do is to calculate the depreciation of building structure and accumulated depreciation, and by deducting the accumulated depreciation from the cost, we got the value of this office, which should have to be reported in the financial statements at 31st March 2015. So can you calculate the amount and reply me what should be the right answer? Is it A, B, C, or D? What should be the right answer of this question? What should be the right answer of this question? Yes, the right answer for this question is A. Very good. So it's good to see that mostly the students got the right answer. Yeah, that's great. So if you have any question, you can please ask on the chat box. And very sorry for the disturbance. Actually, I'm having a bad fever and cough today, so it might be possible that my cough is going to disturb you people. So I apologize for this. So here I'm giving you my WhatsApp numbers. That is 00923322134671. So this is my WhatsApp number. Oh, sorry, it's 132134466. Sorry. You can simply send me the message on the WhatsApp. I can add you in the group for the March 2017 attempt. So here we can discuss lots of key concepts relating to IFRS. If you have any type of query in paper FR, you can ask me directly in this group. And you can email me even. That my email address is Hamad Sarwar, SARWAR 262 @gmail.com. HamadServer262 @gmail.com. So if you have any question, you can email me, or you can ask any type of question on the email or through WhatsApp. Till the examination date, I'm available for all type of queries. So here are a few questions from the student side. How can we estimate the dismantling cost? How to calculate the dismantling cost? Okay, dismantling cost should be calculated using the present value of the future cash flows. So in the previous question, the examiner has already calculated the present value. So therefore, we have not yet calculated the present value of the future cash flows. But we have to use the simple formula of compound interest rate, that is future value into 1 plus I raised to the power minus n. So this is the formula that we have to use for the calculation of present value. Okay, asking about only the building value. Could you repeat what is the meaning of overhaul that restores asset previously? Okay, the question is relating to overhauling. Okay, at what amount should the office building be shown in the statement of the financial position? Okay, overhauling cost and major inspection. Overhaul cost is actually the major inspection cost that we have to incur, and this cost, when we have incurred, increases the useful life of the asset. So IS 16 says that all overall costs should be capitalized and should be depreciated till the next overhaul. Is every time the examiner will give us the dismantling cost? Uh, yes, examiner can give you the dismantling cost at the future value or at the present value. But if the examiner has given you the future value, assuming the future value is 1000 and the rate is 8%, so by adding 0.08, and if we have to pay the cost after 5 years, then we should use the value of -5. So this shows the time period after which you have to pay the amount. So this is how we calculate the present value. But mostly in the MCQs, examiner give you the present value of the future cash flow. Okay, moving forward. Okay, here we have a question. In accordance with IS 16 property planning agreement, which of the following is true? If an entity decides to use the revaluation model, then all non-current assets must be revalued. Is it true or false? Is it true or false? All non-current assets should be revalued. So the answer is it might be true if the question says that if the entity decide to use the revaluation model, all the assets of the same class should be revalued. So there is no need to revalue all the assets. All the assets of the same class. So it is wrong actually. Entity must transfer the excess depreciation from the revaluation surplus to the retained earnings. Is it true or false? That's false. Because I have already mentioned this, that the transfer which should be based on the policy of the company. So it's false. If an entity decides to revalue the property annually, then this property will not need to be depreciated. Is it true or false? False, yes. You have to charge the depreciation. There is no requirement for an entity to revalue the property on an annual basis. Yes, right. So IS 16 says that you can revalue the asset even after 1 year or after 2 years or after 5 years. So it's all up to you, whatever policy you have selected for the revaluation. Okay. Another question. An entity has decided to adopt the revaluation model for the first time for 31st December 2006. At that date, details relating to two properties were as follows. The carrying amount of the head office is 10,200, its fair value is 10,800. The factory value is 7,875 and the fair value is 7,500. What is the total gain to be reported in the revaluation surplus? So what is the total gain that you should have to report in the revaluation surplus? Can you mention the answer in the chat box? Here you can see this, that there is a revaluation gain of 600. And in the factory, you can see there is a downward revaluation of 375. So the examiner does not ask you that what is the net gain to the company. In fact, examiner has asked that what is the total gain to be reported in the revaluation surplus, means what amount should be reported in the equity. So the loss relating to the factory should be charged in the income statement, and the gain of the head office should be reported in the equity. So the right answer for this is actually D. So this is how the examiner give dodging to the different students. Downward revaluation and impairment loss is same. You can say that the downward revaluation is somehow similar to impairment losses, but there is actually a difference. Why not 225? The 225 will be the right answer if the examiner has asked that what will be the total net gain to the company. because we have got the gain of 600 and there's a loss of 375. So net gain is 225. But the examiner is actually asking that what amount should be reported in the revaluation surplus. So as I have already mentioned that the gain on the revaluation should be reported in equity, but the loss should be reported in the income statement. And the question is asking that what amount should be reported in equity rather than what is the net gain. What is the difference between fair value and the net book value? Fair value is actually the market value of the asset, and net book value is actually the current net book value or current book value of the asset. Okay, we had gain for two different classes of the assets. We had gain uh, for two different classes of assets. Yes, if you have gain on two different classes of assets, then you can add these two values and it should be reported in revaluation surplus. But in the head office area, we got the gain of 600, and in the factory area, we got the loss. So the gain portion should be reported in equity and the loss portion should be reported in the income statement. Okay, now it's your assignment that you have to attempt. Send down note number 6, which is mentioned in my handout of day 1 and day 2, and Chamberlain note number 1 from my handout. So I'm on a daily basis, I will give you some assignments. Then you all have to attempt these assignments regularly. Okay. So let's move on towards the next slide. Sometimes examiner can ask you question relating to IS 40. IS 40 is related to investment property. Investment property could be measured at cost model or it could be measured at fair value model. If we are measuring investment property at fair value, then this measurement should be annual. And all gains and losses should be reported in the income statement. So there is no distinction that what amount should be charged in the income statement and what amount should be reported in the equity. All gains and losses should be reported in the income statement. And there is no depreciation on the assets measured under fair value model. The cost model of IS 40 is 100% similar to IS 16. Like we have to measure at cost less accumulated depreciation and impairment loss. So mostly examiner can ask you question from this portion. So here we have a question from the past paper. Like examiner has given you the value of 10 million of the investment property in 2002, and this value is now become 9.8 million. So there is actually a loss of 0.2 million. So this loss should be reported in the income statement. So the accounting entry will be income statement debit 0.2 and investment property credit 0.2. So this should be the accounting entry for the investment properties. Okay, there is no impact of this gain or loss in OCI. IS 40 investment properties gains and losses will not be reported in OCI. It will only be reported in the income statement. Okay, so let's move on towards the next slide. Okay, this next slide is relating to IS 12. IS 12 is about carrying amount and tax base. Carrying amount means the net book value of an asset or a liability. And tax base means the net book value of an asset or a liability in the books of taxation authorities. And the carrying amount means the net book value of an asset or a liability according to accounting rules. Suppose I have purchased a building with a value of 100 million. then taxation authorities also record this building at a value of 100 million. But if I have charged a depreciation of 20 million here, and taxation authorities is charging a depreciation of 60 million in the first year. So in our books, in accounting books, we got the net book value of 80 million. So we can say this, the carrying amount of this asset is 80 million. But the taxation authorities calculate the value of this building at 40 million after 1 year. So this 40 million is actually called the tax base of the asset or a liability. And the rule for the deferred tax is, if the carrying amount is greater than tax base, the difference will be taxable temporary difference. And when we multiply the taxable temporary difference into tax rate, we got the value of deferred tax liability. So first of all, you have to memorize this, that the taxable temporary difference arises whenever the carrying amount of an asset is greater than tax base. Then the difference is called taxable temporary difference, and by multiplying the taxable temporary difference into tax rate, we got the value of deferred tax liability. If the case is opposite, like if the carrying amount is less than tax base, we got the value of deductible temporary difference. And by multiplying the deductible temporary difference into tax rate, we got the value of deferred tax asset. So sometimes examiner can ask you the question relating to deferred tax liability, or sometimes it might be a deferred tax asset. Mostly at F7 or FR level, examiner ask about deferred tax liability rather than deferred tax asset. So deferred tax liability is the favorite topic of the examiner in paper FR, and deferred tax asset is mostly examined in SBR paper. Okay, so let's start from the question. The question is Dugan's. So Dugan is actually the question of the past paper, and it is the most recent past paper. I think it is the past paper of September and December attempt, in which the examiner has asked the question with the name Dugan, and we are attempting the note number 3 of Dugan. The balance relating to the tax in the trial balance to the under over provision of the from the prior year. The tax estimate of the year is 2.1 million. So all you need to do is just to simply prepare a T account for the tax. So whatever the values given to you should be reported as opening balance. So we got the value of 130 credit opening balance, and in the current year the company has recognized a current tax of 2.1 million, that is 2100. In addition to this, there has been a decrease in taxable temporary difference of 2 million in the year. Decrease in taxable temporary difference in the year. Dugan companies pays tax at 25%, and the movement in the deferred tax are to be taken to the statement of profit and loss. So all the movements should be recognized in P&L. So we have to calculate the closing balance of deferred tax. So in the original question, I think there is some. In the original question, examiner has given us only the value of this current tax. Now you have to calculate the deferred tax liability. So there is a decrease in the deferred tax liability of 2 million. Just selecting the pen. Okay. Now examiner has given us highlighter. Okay. Examiner has given us the decrease in the taxable temporary difference, but it does not mention us the opening balance of the deferred tax liability. So we don't know the opening balance of the deferred tax liability, and it only shows that there is a decrease in deferred tax. So whenever this comes in the question, it is recommended to calculate the tax expense. It is always okay through this equation. So tax expense is equals to current tax plus increase in DTL or less decrease in DTL plus last year's under provided tax. So if the examiner does not give you the opening balance, you have to calculate the tax expense through this equation. So for the current year, the current tax is 2.1 million, and as you can see, there is a decrease in taxable temporary difference. So 2 million into 25%, there will be a decrease in the deferred tax liability of how much amount? 0.5. Yes. So increase in deferred tax liability should be added in the current tax, and decrease in deferred tax liability should be deducted. And if there is a under provided tax on the previous year, it should be added, and if there is a over provided tax in the previous year, it should be deducted. So what does this 130 represents? Is it a under provided tax or over provided tax? Is it an under provided tax or over provided tax? It is actually an over provided tax. So if we have got the value on the debit side, it means we have an under provided tax, and if we got the value on the credit side, it means it's an over provided tax. So the under provided tax should be added and the over provided tax should be deducted. So this is how we should calculate the tax expense of Duggan Company. Okay. So moving towards the next slide. Now, in this question, you can see that triage note number 4. You can see that the deferred tax and the current tax, both taxes are given to you. The deferred tax and current tax, both taxes are given to you in the opening. So all you need to do is to calculate by reporting the deferred tax opening balance here and current tax opening balance here. A provision of 2.7 million is required for the current income tax. Provision of 2.7 means there is a liability in the current tax, that is 2.7 million, 2700. The balance on the current tax in the trial balance is the under over provided tax. You can see that this is an under provided tax. In addition to the temporary differences relating to the information in note number 2, at 31st March 2006, the carrying amount of the triage net assets are 12 million more than the tax base. The carrying amount of the triage net assets are 12 million more than the tax base. Whenever the carrying amount is greater than the tax base, then there will be a taxable temporary difference. So here the examiner has given to us the 12 million taxable temporary difference. So by multiplying this amount with the tax rate, the tax rate is 20%. So by multiplying 1200 into 20%, we got the value of 240. So there is a deferred tax liability of 240. Plus, the question says that in addition to the temporary difference relating to the information in note 2, note 2 is what we have already covered in the slide of IS 16. And in IS 16, we have identified there is a revaluation gain of 7,800, and on which we have booked the deferred tax liability of 1560. So it's 12,000. So there is a deferred tax liability of 1560 relating to the revaluation. So at the closing, you have to show the deferred tax of all the information given to you. So it could be uh, given to you relating to the revaluation, or it could be given to you in the uh, question that is relating to the carrying amount in the tax base. So the closing value of the deferred tax liability should be the total amount. Then 1560 should be reported in the revaluation surplus, and the difference should be reported in the income statement. So please calculate the amount which should be reported in the income statement. So that is 700 plus 2700 plus 1560 plus 2400 minus 3200 minus 1560. So the amount which should have to be reported in the income statement is 2600. So this amount is the current liability in the income statement. This amount should be the non-current liability in the balance sheet, and this amount should be reported in the income statement. So if you have any question relating to this part, you can ask it immediately. How do you get 7,800? 7,800 is actually, you can see here that we have already solved this part in this slide. So here we have calculated the 7,800. So basically the adjustment we are solving right now is relating to the triage company. So it is note number 2. And right now we are adjusting, we are doing the calculation of taxation by incorporating this 7,800 and its tax impact. Okay. So here we are. Okay. If you have any question. Okay. Why did we write RR 1.60 on the credit side? Actually, the accounting entry for this part is revaluation reserve debit and deferred tax liability credit. As it is a taxation account, so we have to credit this 1560, and it shows that the debit impact will be in the revaluation reserve. Why 1560 plus 2400? Actually, we have to report the total deferred tax liability in the non-current liability area. So there are two deferred taxes in this question. One is relating to note number 2, which appears on this 7,800, and the other part is relating to the 12 million. So the total deferred tax liability of the company is 2400 plus 1560. How we get 3960 and why do we show in the non-current liability? 3960. Yes, 3960 should be reported in the non-current liability area. Current liability, okay. In the current liability, we have to report the current taxation, that is 2700. I don't understand what 2400 on the debit side. Actually, it's not on the debit side. Whenever we are preparing the account of the liability, so the closing balance will be reported on the debit side. It does not mean that it is a debit balance. It is actually a credit balance, but we have to take the carry down on the debit side. How was the deferred tax closing balance computed? Okay, the closing balance of the deferred tax is calculated as we have given 12 million 12 million taxable temporary differences. And how we have identified this is a taxable temporary difference? You can read this point that the triage net assets are 1200 more than the tax base. So the carrying amount is actually more than the tax base. So this 12 million is actually the taxable temporary difference. Now IS 12 says that you have to book the deferred tax liability on all the taxable temporary differences. So I have just multiplied 12,000 into 20% and I got the value of 2400 deferred tax liability. So this 2400 is related to 12,000 actually. And there is a revaluation gain of 7,800 and 1560 deferred tax liability appears because of the gain of 7,800. And we have to report both deferred tax liabilities in the non-current liability section. Okay, can we solve this question as well using the equation? Yes, we can solve this question using the equation. The current tax is 2,700 plus increase or decrease in deferred tax liability. So the deferred tax liability of 3,200 has decreased from 3,200 to 2,400. So 3,200 minus 2,400, we got the value of 800. So there is a decrease in deferred tax liability of 800 and under provided tax is 700. So when we calculate these, we got the value of 2,600. So even we can calculate this through the equation. Can you explain how the value of SOPL 2,600 was calculated? 2,600 is calculated. I have just added all these values on the debit side and deducted these two values on the credit side. We got the balancing figure of 2,600. Okay. Now it's your duty to attempt send down note number 5, terminate note number 7, and Chamberlain note number 5. So please do attempt all the practice questions which I have given to you. So now here is the handout. These are the 5 questions that we have to attempt. So I'm giving you the assignment to attempt these all questions. Like in the Duggins right now, we have attempted note number 3 already. This portion is what we have already attempted, note number 3. Secondly, okay, then this is the triage question. We have attempted note number 2 already. You can see here. We have attempted note number 2 and note number 4 of triage. Okay. Okay, from the send down, this is the send down question. Uh, Okay, I think we have not yet attempted the single part of the sender question. Then this is the tourmalet. Have we attempted any adjustment? Yes, this is the part of note number 4 is we have already attempted. So I am actually trying to give you the key concepts of the accounting standards, and we are practicing actually some key notes of these 5 questions. So all of you are required to attempt all these 5 questions. I will give it to you till the next class. And all of you are required to solve these questions in the platform of ACCA. So this is the platform of ACCA. You can see here that this is the platform of ACCA, and you have to solve your answer in this worksheet. So you have to prepare income statement and balance sheet of the question which I will be given to you, and you have to save this worksheet and you have to email me, and I will check your sheets and try to give you the constructive feedback about your solution. Okay. Okay. So we are moving towards the next slide. Here is a question for you. I'm giving you just 2 minutes to kindly solve this question and reply your answers in the chat. We've already attempted this part. Yes, here is a challenge question for you. I'm giving you just 1 minute. Yes, you can even send me the screenshot of your answer, or you can even solve the question on this Excel sheet and send it to me. Okay, please solve this part of the question and reply your answers immediately. You only have 1 minute. Okay, the time is over. Some students says that the answer is C. Some students are saying that the answer is B. Some is confused in A or D. So what should be the right answer? Do remember this point that examiner is very sharp, and examiner is going to ask a very technical question as far as the MCQs or OTQs is concerned. So it's very important for all of you to please read the requirement of the question. Okay, I'm just starting the question. In accordance in okay, just first of all I have to select the pen. In accordance with IAS 12 income taxes, what is the impact of the property evaluation on the income tax expense? Okay, what is the impact of the property evaluation on the income tax expense? Now, here you can see that there is a revaluation in the building from 2 million to 2.5 million. So there is a revaluation gain, and I have already discussed this in IS 16 that the revaluation gain will be reported in equity and its tax impact is also reported in equity. So whenever we are going to solve this question which says that what will be the tax impact that should have to be charged in the income statement as an expense, so we have to ignore this part because the tax impact of the revaluation gain will also be reported in the equity. But in another situation, the company has an office purchased for 500 earlier in the year, but subsequent discovery of the defects reduced its carrying amount to 400,000. So there is actually a downward revaluation from 500,000 to 400,000 of 100,000. And whenever there is a downward revaluation, it should be reported in the income statement, and also its tax impact will be reported in the income statement. So the tax will be at 30%. So there will be actually a deferred tax asset of 30,000. And the accounting entry for this deferred tax asset will be deferred tax asset debit 30,000 and income statement credit by 30,000. And the right answer for this is C, because it says that the income tax expense will be decreased by 30,000. Why ignore the revaluation 500? I have already discussed this, that the revaluation gain will be reported in the equity section. So its tax impact will also be reported in the equity. And the question clearly says that what amount should be reported in the income statement as a tax expense. So we have to take the deferred tax only related to the income statement portion rather than the equity section. Okay, is that clear? Shall we continue further? Okay. Now here is another challenge question for you. I'm giving you just 1 minute to please solve this question. I'm giving you just 1 minute to solve. So please tell me your answer. Is it A, B, C, or D? Is it A, B, C, or D? Okay, let's start the question. What adjustment is required in the income tax expense? A mighty IT company in the statement of profit and loss for the year ended 31st December 2005 to the account for the deferred tax of the development cost. So this is actually related to the development cost. In January 2006, the accountant at the Mighty IT company produced the company's draft financial statement for the year ended 31st December 2005. He then realized that he had omitted to consider the deferred tax on the development cost. In 2005, the development cost of 200,000 had been incurred and capitalized. We all know that we have to capitalize the development cost if the criteria of IS 38 are met. So the carrying amount of this development expenditure is assuming 200,000. The development costs are deductible in full for tax purpose. This means that the taxation authorities is charging development cost as an expense rather than asset. So we have calculated and recognized the asset at a value of 200,000, but the taxation authorities is recognizing this asset at a value of 0 because they are charging the whole amount as an expense in the income statement. So in the books of taxation authorities, the value of this development expenditure is 0. But from the accounting perspective, we have recognized the carrying amount of 200,000. So you can see here the carrying amount is greater than tax base. There is a taxable temporary difference of 200,000. And by multiplying this with the tax rate, we got the value of deferred tax liability of 60,000. So the accounting entry should be income statement debit and deferred tax liability credit by 60,000. So there is an increase in the tax expense. So the right answer is B. So the right answer is B. Is that clear to all of you? Yes. Okay. Here is a challenge question for you. I'm giving you just 1 minute to solve this question through the equation. This is the equation that we have already. Current tax plus movement in deferred tax plus last year's under provided tax and over provided should be deducted. So this is the scenario for you. You are required to calculate the tax expense that should be reported in the income statement. Please do the calculate the tax expense through the equation. Just 1 minute. There's a question from one of the student that uh, if we have reduced the tax, how come the taxes increase? Actually, we have booked the accounting entry of income statement debit and deferred tax liability credit. In the previous slide, you can see here income statement debit. So whenever we debit the income statement, it means that we are increasing our tax expense. And the question is asking the same, that what adjustment required in the income tax expense. The income tax expense is actually increased when there is an increase in deferred tax liability. And if there is a decrease in deferred tax liability, then income tax expense should be decreased. Okay. Okay. The tax expense should be calculated as current tax. There is a current tax balance of 4.4 million. Deferred tax. Deferred tax. No, the existing credit balance on the deferred tax is 2.5 million and the provision required. Okay, it's not a deferred tax value. The current tax value is 28 million and the deferred tax has increased from 2.5 to 4.4. So there is an increase in deferred tax liability. So what amount? The increase in the deferred tax liability will be with 1.9. You have to add the increase in deferred tax liability 1.9 and existing debit balance on the current tax account means it's an under provided tax. So we always have to add the under provided tax. We got the value of 28 million plus 1.9 million plus 2.4 million. We got the value of 32.3 million. So some of the students give the right answer, that is 32.3 million. That's very good. So if you have any doubts, okay, there is a question that which gain should be taken to OCI and which one is to the P&L. The gains on the revaluation of the property, plant and equipment should be reported in the equity and OCI. But the losses on the property, plant and equipment should be reported in the income statement. But in the first year, company has got the loss which have booked in the income statement. But in the second year, they got the gain. So the gain amount should also be reported in the income statement. So for the first year, if there is a gain under IS 16, then it should be reported in OCI. But if there is a previous loss in the income statement, then this gain should also be reported in income statement. But as far as IS 40 is concerned, all types of gains and losses should be reported in the income statement. So there is no worries about IS 40 accounting treatment. But the treatment of IS 16 is sensitive. The gain should be reported in OCI, but the loss should be reported in P&L. But if there is a previous loss in the income statement, then the gain should also be reported in the income statement. Okay. So there are some students who wants some break. So I think let's take a break of 5 minutes. So I'm coming after the break of 5 minutes. So let's have a cup of tea in this break. Welcome back. Welcome back. Let's start the session again. There is a student who is still confused about which gain should be reported in OCI and which gain should be reported in PNL. If I give you a very precise answer of your question, then do remember this, that if there is a revaluation gain in tangible or intangible asset, then it should be reported in OCI. So there is only one type of gain that should be reported in OCI, that is the revaluation gain. All other types of gains and losses should be reported in income statement. So there is only one type of gain that should be reported in OCI, that is the revaluation gain on tangible and intangible non-current assets. Means, what does it means? It means the assets of IS 16 and IS 38. Is that clear? So let's start the financial instruments area. First of all, you should know the definition of financial instrument, financial assets, and financial liabilities, and equity instrument. Financial instrument actually is a contract in which one party creates the financial asset, then the other party creates the equity instrument or financial liabilities. So you have already studied about assets and liabilities and equity, but there are some assets which are called financial assets, and some types of liabilities are called financial liabilities. So what are the assets which are considered as financial asset? The one is the cash, the equity instrument of another entity, a contractual right to receive cash means debtors or loan assets. These are the assets which are covered under the scope of financial instruments, or these are actually called financial assets. Financial liabilities includes all types of contractual obligations. Contractual obligation means creditors, loan notes or debentures, bank overdraft, or any other type of contractual obligations. But do remember this point, that the liabilities which are not on contractual basis should not be considered as a financial liability. Like the tax liability is not a contractual obligation, so it should not be considered as a financial liability. The provisions, the provisions under IS 38, sorry, the provisions under IS 37, the provision under IS 37 should not be considered as a financial liability because these are not contractual obligations. Equity instrument is the same as you have already studied in your previous papers. So the examiner can ask you the question from the financial instrument area. The first one could be related to the simple loan. The question is why not IS 37 is a financial liability, because mostly the liabilities considered or covered under IS 37 are not contractual obligations. Like uh, if I have breached the contract, then I have to pay this liability. This is not actually the financial liability. So the penalties and legal cases and the liabilities are considered under legal cases are not actually financial liabilities. Okay, so the examiner can ask you the question relating to simple loan. So whenever you see a simple loan, do remember this: the simple loan calculation and the calculation of the redeemable preference shares is same. Actually, the redeemable preference shares according to IS 32 is similar to loan. Therefore, the calculation of both the instruments will be the same. All you need to do is to record the obligation at start, then interest, then payment, and obligation at end. Obligation at start should be the par value of the instrument minus issue cost of the instrument and minus discount. So this amount should be considered under this box. So whenever you see a simple loan, you have to prepare this table, and this table is called amortized cost table. And the obligation at start should be measured at the par value of the instrument less issue cost and discount. The interest should be based on effective rate. So the examiner will give you always two rates. The one is the effective rate and the second one is the nominal rate. And the payment will be made at the par value into nominal rate. And then by adding or subtracting the values, we got the value of obligation at end. Like I'm going to attempt this question. The 5% loan note was issued on 1st April 2009 at its nominal value. Nominal value or face value means the par value. So the nominal or the par value of this instrument is 20 million. So for the year 1, obligation at start should be 20 million minus issue cost of 500,000. Issue cost of 500,000 means 0.5 should be deducted from this value. And if the question says you there is a discount, then it should also be deducted from this portion. So the discount and the issue cost should be deducted. Then we got the obligation at start. And interest should be based on the effective rate. So whenever you got the question relating to simple loan, there must always be a rate which is called effective rate. The effective finance cost of the loan notes is 10%. So the interest should be based on 10%. So the obligation at start is actually 19.5, and by multiplying 19.5 by 10%, we got the value of 1.95. But there is a warning sign here when you are calculating the interest. Interest should be charged in the income statement based on the time period. So first you have to see that whether there is a time period of 12 months or not. If the time period is less than 12 months, then you should have to proportionate your finance cost. So the company has issued the loan on 1st April 2009, and right now it's 31st March. Right now it's 31st March 2010. So actually the 1 year is already completed. Then you can recognize interest cost of 1.95. But if the time period is less than 12 months, then it should have to be proportionated according to the time period. And whenever we are going to make the payment, do remember this point that payment will always be made on the par value. The par value is 20 million into 10% into 5%, which is the nominal rate. Nominal rate is given to you. Here is 5%. So 20 into 5%, we got the value of 1 million. So the obligation at end will be, please calculate the obligation at the end. That is 19.5 plus 1.95 minus 1 million. So the obligation at end is 20.45. So do remember this point that this finance cost should be reported in the income statement, and this amount should be reported in the balance sheet under non-current liability. And you have to see in the trial balance whether the company has paid this amount or not. If the company has not paid the amount till the year end, then this amount should be reported in current liability as an interest payable. So the finance cost interest should be charged with this amount at effective rate. The closing value of the obligation should be reported in non-current liability. And if the payment company has not yet made the payment of 1 million, sir, where we did get 1 million from? 1 million is calculated actually by multiplying the par value of the instrument, that is 20 million, with its nominal rate of 5%. So by multiplying 20 million into 5%, we got the value of 1 million. So you have to calculate and deal the simple loan in this manner. Now, one of the most important and the favorite area of the examiner in the financial instrument side is the compound instrument. Whenever you see the compound instrument, it means the instrument having both equity and liability component. And as we all know that the equity should be reported under equity and the liability should be reported under liability. So IS 32 says that whenever the company has issued compound instrument, you have to separate the equity component and the liability component in the instrument. And after separating equity and liability, this portion should be reported under liability and this portion should be reported under equity section. So let's start this question. Triage issued 400,000 $100 6% convertible loan. Convertible loan means the loan which has got the option to convert into ordinary shares. The loan which had got the option to convert into ordinary shares. So the option should be considered under equity and the remaining part of the loan should be considered under liability. So first we calculate the total value of the loan, that is 400,000 into 100. We got the value of 40 million. So by ignoring these three zeros, we have the value of 40,000 actually. On 1st April 2005, interest is paid annually in arrears on 31st March each year. The loan can be converted into equity shares on the basis of 20 shares for 100 loan each. The company has not yet converted the loan, so this information is totally irrelevant. An equivalent loan without the conversion right have required an interest rate of 8%. Okay. For the calculation of the equity and the liability component, IS 32 says that first you have to calculate the cash flows of the loan, assuming the company or the holder does not convert the instrument into ordinary shares. So what will be the cash flows? So loan have got the time period of 3 years, 2006, 2007, 2008. So the loan has got the time period of 3 years. So what will be the cash flows for the 3 years? So the cash flow for the first year will be 40,000 into 6%. It will be 2,400 for the first year, 24,000 for the second year, and 42,400 for the third year. If the holder does not convert the loan into ordinary shares, then in the third year you have to repay the total amount of the loan as well. So for the third year, we have considered the interest and the capital repayment amount. So these are the cash flows of the 3 years. Now, you have been given a discount rate at 6% and 8%. Then what rate we should have to select? You should have to select the rate of a simple loan. An equivalent loan notes without conversion option would have the right of the interest rate of 8%. So you have to take the discount factor of 8%. Why we are taking this value? Because from these cash flows, we have to calculate the present value of the liability. So if you want to calculate the present value of the liability, you should have to take the rates of pure liability. So by multiplying these three values, we got the answer. Please help me in the calculation. 2,400 into 0.93. The cash flow for the first year will be 2,232. The second year, It will be 2064. Great. And for the third year, the amount will be 33,496. So by adding these three values, we got the value of, by adding these three values, we got the value of liability component. Please add these three values. Now the final answer is 37792. So out of 40,000, 37792 is related to the liability component. So the remaining amount will be for the equity option. Yes, the value of the equity option is 2208. So whenever you see the compound instrument, the first step is to separate the equity and the liability component through the rate of the loan without conversion option. Is that clear? If you have any question, you can ask it immediately. Okay. Then the equity option should remain constant in the balance sheet, that is 2208, but the liability component should be amortized over its useful life. So for the first year, the liability should be amortized with the value of 37792. Interest should be based on 8%, and the payment is already we have calculated at 2400. So can you calculate the interest amount, that is 37792 into 0.08? 3023. Very good. So what will be the obligation at end? 37792 plus 3023 minus 2400. We got the value of 38,415. So this amount should be reported under non-current liability. This amount should be shown in the finance cost, and 2400 should be checked from the trial balance whether it is paid or unpaid. If the company has not yet paid the amount, then it should be also be reported in current liability. But for the future periods, equity option will remain the same, and the liability component will be amortized over the life of the loan. So this is one of the favorite adjustment of financial instruments of the examiner. If you have any question, you can ask it immediately. Otherwise, we have to move further. Is it appropriate to compute the amortized cost? I didn't get your question. All loans should be considered at amortized cost. Topic name, the name of the topic. If we deduct the payment from the interest. Is it appropriate to compute? No, there is no need to calculate the excess amount, that is interest minus payment. Okay, let's move on. What about the equity? The equity component will remain the same, and it should be reported under equity section after share capital and share premium. there are some students who wanted to know about my cell number. My cell number is 0092 33 2213 This is my number. You can just send me a message. I will add you in the WhatsApp group. Then we'll be having a detailed concept discussion and chat relating to IFRS. Okay, so let's move on towards the next slide. My email address is HAMMADSARWAR Hamad server 262 at gmail.com. Hamad server 262 at gmail.com. This is my email address. It is highly recommended for all of you to please do attempt the complete questions in the Excel sheet or on the platform of ACCA and email it to me so that I can understand that where you people are making mistakes, and I can give you the reasonable assurance that you can definitely pass the exam if you follow all my instructions. I have given some assignments in the slides and the handout of Word document which comprises of 5 questions. So if we attempt the 5 questions in 2 days, you all will be perfect, inshallah, in final accounts. So let's move on towards the next slide. Now this portion is relating to IS 8. IS 8 is also one of the area where the examiner can ask you the question in the final account. Accounting policy, accounting estimates, and correction of errors. Accounting policy means any type of rule, any principle, any base adopted by an entity for the preparation of the financial statements. Any rule, any principle, any base adopted by an entity for the preparation of the financial statements is accounting policy. Okay. IS 8 says that accounting policy once adopted should be applied consistently. So there is no need to change the policy on an annual basis, or even you cannot change the policy according to your wish. But IS 8 says that if you wanted to change the policy, then it should also be in accordance with IS 8, which says that the change in accounting policy should be applied. So the change in accounting policy can be made only when there is a change in IFRS or the change in management's view that the new policy that the company wanted to adopt is highly reliable and relevant. And these are the only two situations in which you can change the policy. And if you have to change the policy, it should be applied retrospectively. So all the changes in accounting policy should be applied retrospectively. Retrospective means you have to adjust the previous year's amount in the opening balance of the retained earnings. You have to adjust the impact of the previous years in the opening balance of retained earnings. Now, accounting estimates. Estimates are actually made for the future, which is uncertain. Therefore, IS 8 says that all the estimates should be reviewed annually, and if there is a change, then the change should be applied prospectively. Prospective means whatever you have made in the previous years, just ignore that and follow the new estimates in the current and future periods. So there will be no adjustments in the previous years. So this is called prospective adjustments. Sorry. Now, correction of errors. Correction of errors includes material prior period errors, which could be intentional or unintentional. And we all know that intentionally, if someone has made the error intentionally, then it will be considered as fraud. So actually, the fraud will be considered under this section. So all material prior period errors must be corrected retrospectively. What does it means? That the errors relating to the previous years should be adjusted in the opening balance of the retained earnings, and error related to the current year should be charged in the current year's income statement. Again, errors relating to the previous year should be reported in the opening balance of retained earnings, and errors relating to the current year should be charged in the income statement. Now here I have a question for you that is again related to triage. Again related to triage. So let's start. In September 2005, the directors of triage discovered a fraud in total 700,000, which had been included in as receivables in the above trial balance, had been stolen by an employee. Actually, one of the employee of the company has stolen $700,000 of the company, which it received from the receivables. So 450,000 of this related to the year ended 31st March 2005, and the rest to the current year. So the current year is actually 2006. So we have 31st March 2005, that is the previous year, and 31st March 2006, that is the current year. So out of 700,000, 450 related to the previous years, and remaining 250 relating to the current year. That is the breakup of 700,000. So when we are going to book this fraud, the accounting entry will be trade receivables credit by 700,000. It should be credit, debit. Now, you cannot charge the whole 700,000 in the income statement. Only the amount related to the current year should be reported in the income statement. And the amount related to the previous years should be reported in the retained earnings opening balance. So it should be adjusted against the opening balance of the retained earnings. So this is called retrospective adjustment. So the previous year's information or fraud should be adjusted in the opening balance of retained earnings, and the current year's fraud should be charged in the current year's income statement. Any question? If you have any question, please ask. Okay, can you explain? Okay, the directors are hopeful that the 50% of the losses can be recovered from the company's insurance. Now, if there is a chances that the company can recover some of its loss from the third party, then this loss can only be recognized, this amount can only be recognized when the chances of receiving this amount is virtually certain. So there is no information about the chances of this payment will be received by the company. But if the scenario clearly says to you that there is a chance of virtually certain chances that the company will receive the amount from the insurance company, then you should have to record receivables debit from the insurance company and income statement credit. So this should be recorded separately. Only when the chances of the receipt is virtually certain. So from this scenario, you have to ignore this information that the directors are hopeful that 50% of the losses can be recovered from the company's insurance. Okay, there are some questions from the student side. Can explain the few lines related to the provision. Uh, I have a, I think I have not yet discussed provision. What about the percentage? What about the 50% that the losses will be recovered? 50% I have discussed this. Where is the credit going? Credit going? I didn't get you. Can you repeat the scenario? Can you please provide some inputs and repeat this last thing about directors? Okay, actually, uh, there is an employee who has stolen the receivable balances of the company. Actually, that individual has received the amount of the company on the behalf of the company, and this individual has gone from the company. So that individual has stolen the whole amount of 700,000. But this fraud is done in 2 years. 450 of the fraud related to the previous years, and 250,000 of the fraud was done in the current year. So IS 8 says that you have to book the fraud retrospectively. The previous year's related fraud should be recognized in the retained earnings opening balance, and the current year should be charged in the income statement as an expense. But if the amount of the loss will be recovered from the third parties, then this loss or reimbursement can only be recognized when the chances of the receipt is virtually certain. So this is actually, you can say that sometimes some sort of contingent asset which you cannot recognize until the chances of the receipt is virtually certain. What if no information is given about the chances to receive the reimbursement? You just ignore this portion. Okay, here I am giving you the question. You have only 1 minute to solve this question. Which of the following is a change in accounting policy under IS 8? You are required to read all the options and write your answers in the checkbox. Okay, so if the receivable is virtually certain, the loss of the receivable related to the last year's value 50% is recoverable too. Yes. Accounting estimate should be considered prospectively. It's not respectively. Accounting estimate should be considered prospectively. Please write your answers in the checkbox. Okay, we have received some multiple answers from the students. Now the question is, which of the following is a change of accounting policy? Change in accounting policy means any type of change in the presentation, or it can be the change in some rule Like if we have moved from FIFO to weighted average, it's a rule, or it could be the change in the presentation. But whenever we have done some estimation, then it should be considered as an accounting estimate. So the question is saying that which of the following is a change in accounting policy? Let's start with option D. Revising the remaining useful life of the depreciable asset is an accounting estimate actually. Changing the value of the subsidiary inventory in line with the group policy or the inventory valuation when preparing the consolidated financial statement. It is basically an adjustment. It is not a change in accounting policy. So this answer is also wrong. Switching the purchasing plant finance lease from previously policy of purchasing plant on cash. It is not an accounting policy. It is the operating policy that we should have to purchase the plant on credit or on cash terms. So the right answer is A, classifying the commission earned as revenue in the statement of profit and loss, having previously been recognized as an operating income. Like previously we are recognizing the income uh, commission received as operating income or other income, and now we are including this commission in the revenue. So this is called actually the change in presentation. So whenever we have got the change in presentation, then it should be considered as a change in accounting policy. Okay. So be careful when you are doing MCQs. You have to be very attentive and read the question very carefully. Examiner can give you a lot of dodging in at least in the MCQs area. And believe me, this is the area in which you can score 100% because the 60% of the paper will be close-ended paper. And if you have attempted all the questions correctly in section A and B, you can score even 60 out of 60 marks. And in the section C, if we even score 50% marks, then your total marks in paper FR will be 80%. So it is actually a high scoring papers. So never ever think about that you are going to score 50% or 60%. Try to plan 80% or 90% in this paper. And you can even easily achieve this if you have got the strong concepts and if you are focusing on the prepare to pass session of Hamad server. So moving towards the next standard. So the next standard is relating to IS 38 or 36, sorry. IS 36 is about impairment. You can expect one or two questions definitely in the section A or section B related to IS 36. IS 36 says that impairment occur whenever the carrying amount is greater than the recoverable amount. Recoverable amount means the maximum benefit that you can extract from the asset. So recoverable amount is actually the higher of net selling price and value in use. And value in use is actually the present value of the future cash flows. There are few points that you should have to memorize, that there is no need to check each and every non-current asset for the impairment on annual basis. You only have to check the impairment when there is any indication that the asset may be impaired. So if there is some indication that the asset is impaired, then you have to calculate the impairment loss. Otherwise, there is no need to calculate the impairment review, or there is no need to check the impairment of any type of asset on an annual basis. But there are three type of assets for which you have to calculate or check the impairment review annually. The first one is the goodwill. The second one is intangible asset not yet available for use and intangible asset with an indefinite life. These are the three assets for which you have to check the impairment annually. Otherwise, there is no need to calculate the impairment loss or check the impairment on an annual basis, unless you have got any indication for the impairment. Is that clear? Moving towards the next slide. Sometimes the examiner says you to calculate the impairment of a single asset. Sometimes the examiner can give you the to check the impairment of group of assets. So when we are calculating or checking the impairment of group of assets, then it is called cash generating unit. The mechanism and the calculation will be same. The mechanism and the calculation will be same if you are calculating the impairment loss or recoverable amount of one asset or group of assets. But there is a difference when we are allocating the impairment loss. When we are allocating the impairment loss should be first allocated against any obvious impairment, then on the goodwill, and the third on the pro rata basis. So impairment occurs whenever the net book value is higher than the recoverable amount. Suppose in the books of accounts we got the value of an asset with a value of 100, but we know that we can extract the maximum benefit from this asset is 60. So it means we are recording the value of the asset as 60, but we can extract the maximum benefit with a value of 60. So there is an impairment loss of 40. And impairment loss should be charged in the income statement as an expense. Now here we have a question for you in which you can see there is a cash generating unit. So I'm not going to calculate the impairment of an individual asset. We are working on the group of assets. So we have been given a property, plant and equipment with a value of 200,000. Goodwill is 50,000. Product patents is 20,000. And net current asset is 30,000. Do remember this point that impairment will never be allocated on current assets. Okay. So the carrying amount is 300,000, but the recoverable amount is 200,000. So here you can see the carrying amount is greater than the recoverable amount. Then there is an impairment loss of 100,000. So this impairment loss should always be allocated in this order. First on any obvious impairment, second on goodwill, and third on pro rata on non-current assets. Okay. So now I am going to allocate the impairment loss of 100,000 on these assets. There is no indication in the question about the obvious impairment. There is no indication in the question about the obvious impairment. Okay. So first of all, we have to allocate the impairment loss of 100,000 on the goodwill. So first 50,000 should be allocated on the goodwill. Impairment will never be allocated on current assets. So there will be no allocation on the current assets. After the goodwill, we have to pro rata. Pro rata means weighted average. So we have two assets, that is property, plant and equipment and product patents. So what is the weightage of property, plant and equipment? The property, plant and equipment weightage is 200 out of 220. And the remaining unallocated impairment loss is 50,000. So can you calculate the amount? What will be the amount? That is 200 divided by 220 multiply by 50,000. We got the value of 454. And the patents portion is 20 upon 220 multiply by 50,000. So actually 4545 is approximately the value of the patent. So after the impairment, the revised values will be, now the question is saying that how what would be the value of the company's property, plant and equipment? So the question is only asking about the property, plant and equipment. So the value of the property, plant and equipment is 154,545. So this is the requirement, and this is how we have calculated the and allocated the impairment loss. So if you have any question, you can ask it immediately. We are already running short of time. Please ask any question if you have. Okay, example of obvious impairment. Example of obvious impairment means that the question, suppose, has given you the information that the product patents are now worthless and the value has become zero. So there will be the obvious impairment of 20,000 in the value of product patents. Or the question says to you that the product patents is now worth only 10,000. So from 20,000 to 10,000, there will be an obvious impairment of 10,000. So the question will clearly tell you that which asset is already impaired. That is called obvious impairment. Why we are dividing to 20,000? Actually, we have to allocate the impairment, remaining impairment on pro rata basis. So we have only two assets, one with a value of 200, second with the value of 20. And on these two assets, we have to allocate the impairment of 50,000. And IS 36 says that you have to use pro rata, means weighted average. So by adding these two values, we got the value of 220. So weightage for the first asset is 200 divided by 220. And for the second asset, it will be 20 upon 220. Any other question? Please ask. Please ask it immediately. Shall we move forward? Okay. Now, the question is, which of the following is not an impairment indicator? Do remember this point. Impairment indicator means that any type of hint or any type of information that will tell you that the value of the asset has gone down. This will be considered as an impairment indicator. So all of you are required to just read this question quickly and tell me which of the following is not an impairment indicator. Okay. Advancement in the technological environment. Now this could be the impairment indicator, because whenever you see an advancement in the technological environment, there will be a serious losses in the value of the asset. Like whenever when the Apple company has introduced iPhone X Max, there will be a serious decline in the value of iPhone 7. Or if someone has iPhone 8, there will be a serious decline. So this is will be considered as one of the impairment indicator. So this is an indicator. An increase in the interest rates, which increases the discount rate of an entity. This is also an indicator. The carrying amount of the net assets is higher than the entity's number of shares in issue multiplied by share price. Whenever the carrying amount of an asset is higher than the market capitalization, it means the value of the share price is above the par value. So this will not be considered as an impairment indicator. It will be considered as an impairment indicator whenever the carrying amount, the value of the carrying amount is lower than the entity's share price. The estimated net realizable value in inventories has been reduced due to fire damage, so this value is greater than its carrying amount. This can also be considered as an indicator. So the right answer for this question is C. Now here is a immediate question for all of you, please. What is the logic behind the increase in the interest rates? Okay, if I give you the logic of from the economics point of view, that whenever there is an increase in the interest rates, the value, the cash of the public will go into the banks. So there will be a serious decline in the bargaining power of the public, which decreases the demand. And whenever there is a decrease in demand, there will be a there will be a chance of impairment. And if I give you the value, uh, if I give you the answer for through finance area, that whenever there is an increase in the interest rate, there will be the decrease in the present values of the future cash flows. So whenever there is a decrease in the present value of the future cash flows, which decreases the value of the recoverable amount. Therefore, increase in the interest rate will be considered as an impairment indicator. Okay. Here we have a question on 1st April, and we are going to calculate the impairment at 31st March. There is a value of the asset is 248,000. So first you have to calculate the depreciation at 12.5%. Can you please tell me the value of the depreciation? 248 into 12.5%. It's 31,000. So what will be the net book value? What is the net book value after deducting the accumulated depreciation? That is 217,000. So this is the net book value. Now examiner has already given you the present value of the future cash flows. That is 21600. And the net selling price of 200,000. IS 36 says the recoverable amount is the higher of net selling price and value in use. Higher amount is 214,600. So the difference will be considered as an impairment loss. So please calculate the amount of the impairment loss. 214,600 minus 217,000. The amount of the impairment loss is 2,400. Then what amount should the plant appear in the statement of financial position at 31st March? So the value should be C. Higher amount is 252. No, 252 is actually the future cash flows. We have to take recoverable amount is the higher of present value of future cash flows and net selling price. We never consider the future value of the cash flows. So the present value of the future cash flows is 214,600 and the net selling price is 200. We have to take the higher value of among these two. Okay. So I think I have covered. This is your assignment. So for the from the next session we will be starting from here. Now some key points to remember. Okay, we have okay, you can see here that we have covered all the adjustments of triage. So please note it down that all of you are required to prepare the financial statements of triage company, and you have to send it to me at my email address, that is hamadserver262@gmail.com. So all of you are required to prepare these statements. The first statement is prepare a schedule of adjustments required to the draft profit before interest and tax to give the profit or loss of the triage company, and prepare the statement of financial position. So you are required to calculate, you are required to prepare the statement of financial position, and in the next class we will be discussing the EPS portion of this question. So all of you are required to prepare the the statement of adjustments in the P&L, that is part A, and part B, that is related to the balance sheet. And send down, from the send down question, you can attempt note number 3, note number 5, note number 4, and note number 7. So you are required to prepare the income statement and balance sheet of send down company, ignoring note 1. We have not yet covered note number 1. So this is one of the technique I am giving you the hint that there are some situation in which the examiner can give you a very tough question in which you will be blank in one or two adjustment. So all you need to do is to ignore that adjustment and prepare the income statement balance sheet. So assuming you don't know how to solve note number 1 of send down, then try to attempt note number 2, note 3, note 4, note 5, note 6, and note 7 of send down, and prepare the income statement and balance sheet. So I'm giving you two questions, triage and send down, for tomorrow. So before coming in the next class tomorrow, all of you are required to solve these two questions. Now, from the termulate perspective, you are not required to solve termulate right now, and not even Chamberlain. So I'm giving you just two questions, triage, and second one is uh, triage and the send down. And when you are doing send down, ignoring part 1, and please give your valuable feedback to the ACCA, that how did you find this session, is it useful for you, so that ACCA can plan these type of sessions in the future. So thank you very much for paying attention in the session, and we will start our session tomorrow at the same time. Please do attempt all the assignments before coming in the next session. Thank you very much.